Thanks, Dave. Thanks, everyone, for tuning in this afternoon. Glad to cap things off from a lot of great presentations today. We are going to specifically talk about day trading the Emini futures for the next 40 minutes or so. And even more specifically, we're going to talk about the day trading using the 1-minute chart on the Emini futures. We'll pull in lots of examples from more or less the ES, so the S&P E-mini, but the concepts that you'll learn here and the various techniques that I use, from things like trailing my stop and how I enter and manage the trades, you can transpose those concepts across all different markets and time frames. It doesn't even have to be futures, and it doesn't even have to be day trading for that matter. So the nice thing about having a simple trading strategy is that you can transpose it to other markets and other time frames. So we'll talk about some ways you can do that, some of the benefits of day trading futures, and how you can kind of tie it all together to either be a full-time trader as your primary profession, or depending on what time zone you're in, it can be fairly easy to trade in the morning at the NYSE Open, or depending on your time zone, in the evening for a couple hours, and then also have a day job or some other something else that takes up your time. So as Dave mentioned, my name is Tim Racette, and I blog over at EminiMind.com. We'll talk a little bit here about what you'll learn, a little bit about me, and then we'll dive in. So we're going to go through 3 techniques that you can use to day trade the futures markets. We're going to be looking at examples from the 1-minute chart, just basic candlesticks, so nothing fancy, proprietary, anything like that. Just a basic 1-minute chart. And we'll talk about what I call the high-low bar, low-high bar strategy, places to find trade entries and things like that. And then we'll also talk about a really effective trail stop technique that I use both from an intraday trading perspective, but also for swing trading daily charts as well. And the great thing about trading, as other presenters today have alluded to, and probably a big reason why you got into trading in the first place, or the allure of trading is desirable. Developing that flexible lifestyle that allows you the financial freedom to free up your time, allow you to do the things, have more time, which allows you to do the things that you'd rather be doing, whether it's spending time with your grandkids or kids or friends, family, sports, all that kind of stuff, playing golf. And so a big part of my trading philosophy is really limiting my time in front of the screen so that I'm not consumed by trading, as kind of turning it into another 9 to 5. And so while yes, at first it's very kind of necessary to put a lot of screen time in, a lot of time studying, a lot of time looking through your notes and your trade log and your journal, so that you can really build the confidence. And in doing so, by committing up front and then building that confidence, you will in turn begin to develop the consistency. So kind of the 3 C's of creating success in any endeavor. So trading is a little bit different in the fact that the more you trade does not necessarily mean the more you make, and the hustle mentality of working harder, trading more, can a lot of times be a detriment. So we'll talk about some things you can do to trade smarter and not necessarily just harder. And then like I said, you can do this part-time or full-time, and there's really a lot of benefits of being what I would consider like from a time commitment, just trading a couple hours in the morning and then getting away from the screen. That even if you're doing a combination of day trading and some swing trading and managing, your 401k or retirement accounts, it doesn't take a huge time commitment. And if you get the ratio of, risk and leverage correct, you don't have to make 1,000 trades in a month to develop, a really nice income. So for those that are unfamiliar with myself, like I said, my name is Tim Racette, and I blog over at EminiMind. I've been trading since about 2006, and I grew up in the Chicagoland area, so I had tons of access to both the trading floor, downtown Chicago, and other online trading platforms. Tom Sosnoff was kind of the co-founder of Thinkorswim, and that was kind of coming on the scene in the early 2000s. So I got the chance to kind of really grow with some of those individuals, Don Kaufman and Tom Sosnoff, and the guys at Infinity Futures and Thinkorswim. And over the years, they've been acquired and bought out, but just being able to surround yourself with other like-minded traders was super beneficial. So I primarily day trade the Emini futures, but I actually got my start swing trading stocks, and in kind of a succession form of starting with swing trading and then dialing down to the smaller time frames is kind of how I landed on day trading after a couple of years of swing trading, and finding some really good success, and just being able to develop the skills and the discipline and the patience to be able to just look at daily bars and swing trade and follow a very simple execution approach, and then realizing, okay, this is scalable to a degree, but if I were to add day trading into the mix, I can then use that same pool of cash over and over again in the same way that you can with swing trading, but on a intraday, day after day basis. So I've had the pleasure of speaking at a number of these presentations online and Traders Expos and things like that. And then outside of trading, I spent a lot of time riding my mountain bike, getting outside. Like I said, I grew up in the Chicagoland area. Now I live in Scottsdale, Arizona for 2/3 of the year, and then have a house up in the Black Hills that I go to in the summer, get away from the heat. So trading has provided a really nice life, and more so the flexibility. There's lots of jobs and careers out there that can pay really good salaries, but if you're chained to your job and your boss and your location, those were the things that really drew me to trading, having the flexibility to kind of go where I want, when I want, and for the most part do what I want. Once you start having kids and you realize the school system and the school schedule can kind of put a damper on some of that, but that's okay. Everything's for a season, and there's still lots of ways we get to have fun as a family and travel around and things. So yeah, getting away from the screen, super important, because if you think back to those times where you had something click or a light bulb moment go off, it's probably not while you were sitting in front of the screen during market hours. At least for me, it wasn't. It's always been, late on a Friday night when I'm going through my trade log, going through Excel spreadsheets, out on a walk, out riding my bike, reading a book that's completely non-trading related, and it just kind of something clicks in my subconscious that allows me to put some of the pieces together. So yeah, get outside, explore. It doesn't have to be anything extreme, or even something like mountain biking, but just getting outside and going for walks is super helpful as well. And then I also am a ASU Sun Devil, so that was kind of my initial tie out to Arizona and the Scottsdale area. And then yeah, you get kind of spoiled being out here in the winter, and Chicago winters are not that enjoyable. So being able to come out here and be here for the good months is a real treat. So let's talk about some of the details about how I set up my chart and how kind of the philosophy around this trading method, and then we'll get into the order execution and then managing the trades from there. So I keep my charts pretty basic. I use Thinkorswim for my charts, but like I said, you can use whatever you want, NinjaTrader, TradeStation. I do my order execution on Tradeovate. I've used different platforms over the years, Infinity Futures. I've used Thinkorswim to trade futures before, but it's really not set up for that. You you need a much higher intraday margin requirement, which isn't a huge deal, but just the platform in general. The active trader is nice, and it's come a long way in 15, 20 years, but a platform like Trade-Evate and Ninja Trader and some of those are a little bit more optimized for day trading futures. So I'll execute on the Trade-Evate platform and then just use Thinkorswim for charts. So basic 1 minute chart. On the left, I've just got the indices, the futures, and in the bottom right, I won't get into this too much today, but the NYSE tick is a super helpful, we'll call it an indicator for day trading futures. It's essentially a relationship of the stocks that are up ticking versus down ticking, moving up versus moving down at that moment. So all the stocks on the NYSE and the net number of stocks going up versus down is what that chart depicts. So if you get a reading of plus 500, you know that at least 500 stocks are moving up. So you could have up, down, and unchanged. And so that's really helpful. The general concept with the NYSE tick is you want to be buying or going long in low ticks and shorting or selling in high ticks. So on your NYSE tick chart, if you're entering a long position, I always glance at the NYSE tick to make sure, okay, I'm in a relatively low tick. It doesn't have to be the lowest tick for the day. I just don't want to be getting in a long position and having the NYSE ticks being up at highs, because essentially that's telling you, okay, a whole bunch of these stocks have all swung to the positive or made an uptick, and so there's a strong chance that they're going to pull back or make a kind of snap back. So if you can be buying in low ticks, selling in high ticks, that will help filter out a decent number of trades that may not be the most ideal placement. So whether you're using a 1 minute chart or a 5 minute chart or Fibonacci retracements or high low bar that we're going to talk about here, a million different strategies, that NYSE tick is super helpful if you're day trading. As far as the candlestick, I'm just using a basic candlestick chart, and the 1 minute chart with the traditional candlestick is how I like to keep things. There's lots of other Hakanashi, Renko bars, range bars, all kinds of stuff, but the traditional candlestick really tells you a lot about the emotion that's occurring kind of at that time frame. So when we're talking about hammers, at the close of the candle, that hammer candle pattern is indicating that price sold off at some point in the middle of the bar, and then it was bought back up. And so when you get a hammer candlestick pattern in the context of an uptrend, especially, that's a good indication that we're going to reverse and continue to the upside. And then in certain instances, when you come down and you're making like a double bottom and you get a hammer, those are another good area to kind of indicate a potential reversal. And so just going back to those basics, when I first started swing trading, and still to this day, one of my first notes in my very first trading journal was buy strong stocks on pullbacks, and then underneath it, sell weak stocks on bounces. And that concept, you can change stocks for futures and intraday, and boom, buying pullbacks in an uptrend, selling bounces in the downtrend. Those basic concepts still hold true. So in an uptrend, looking for things like double bottoms, and then on the flip side, the inverted hammer being just the opposite of the hammer, where you have a tail to the upside, and that's indicating, okay, price at one point pushed higher, and then the bears were able to push it down, or there weren't that many sell buy orders at that point, and the sell orders that were there were able to overwhelm the buy orders and then keep pushing the price lower. So those two candles alone, the hammer and the inverted hammer, are super good reversal bar signals. There's also things like spinning tops and bearish and bullish engulfing patterns, but if we're talking about a 1 minute chart and executing trades on the 1 minute chart, even in the first 2 hours of the day, when I primarily trade, from the NYSE open, 9:30 Eastern time, going, 90 minutes to 2 hours post, you're going to have quite a few, you're going to have 120 1 minute bars in the first 2 hours. So there's a good chance that at least one or two of them are going to be hammer and inverted hammer. So if, when it comes to expanding your trading, if you're starting with the hammer and the inverted hammer and you're making 3-4 trades in a morning session, and you could expand by either taking more setups, expanding to like spinning tops, bearish engulfing and bullish engulfing candles, or you could expand your trading by going increase in size, so just trading the hammer and inverted hammer, but trading more contracts. And then the third way is you could expand by introducing other markets. So you could trade the ES and the NQ or the YM. I wouldn't necessarily recommend trading ES and YM because they tend to trade pretty closely, but ES and NQ can be enough of a divergence that sometimes you'll get a setup on the NQ and not the ES, but NQ can move so fast at times that sometimes it's tough to manage the trade ladder. I know a lot of people like it because of the $5 tick increment instead of $12.50 on the ES, but man, it's once you can get comfortable with the ES and a little bit bigger tick values and bigger dollar signs in general, the pace of the ES is much more manageable, and it just slows it down enough to where it's a lot easier to click around your trade ladder and you're not constantly having to recenter or just scroll up and down really fast. So anywho, selling below an inverted hammer in a downtrend, looking for things like double tops, and it's really powerful because it signals that price was rejected, whether we're trending up or like we're moving up and then we come to some sort of resistance level and then price was rejected and the candle closes at an inverted hammer, or we're moving down and then we start to bounce and then we close as a hammer. That price rejection really tells you a lot in just that 1 minute time frame. So this concept of high of low bar, HLB, or low of high bar, LHB, is just indicating that I want to place my order one tick above the high price of the low bar in the pullback. So if we're looking at this pullback down to the hammer, I'm putting my order one tick above the hammer, and it just so happens to be the lowest bar in the pullback. If I were to put my entry one tick above the red bar prior to this hammer, well, it wouldn't have triggered. We went lower. The hammer made a lower low, and so just putting my order one tick above the red bar prior wouldn't have gotten filled. So getting long above the high price of the lowest bar in the pullback, and then on the flip side, we're going to be looking for the low of the high bar, which would mean selling one tick below the low price of the highest bar in the bounce. And so by, kind of by default, the highest bar is going to be the most optimal point for the reversal, and the lowest bar in the pullback, just by by the wording, the lowest bar in the pullback is going to give you the lowest entry price into kind of the resumption of that new trend. So if you're looking to short, you're looking for the low price of the candle and the highest bar in the pullback, looking for that inverted hammer to go short, and then the hammer to go long. Now, when it comes to stops, I like to put my stop outside of the entry candle. So if we look at the chart here, and if I'm going long above the hammer, then my stop is going to be one tick below the hammer. And if you just use a 4 points as your kind of arbitrary candle size to say, okay, if the candle's 4 points or less, I'm a go, I'll take it. If it's 4 points or more, that's too big and I'm not going to take it. You could get a little fancier and say, okay, if it's 4 points or less, I'm going to trade my standard 4 contracts, let's say, and if it's 4 points or more, I'm only going to trade 2 contracts. So if my stop is further away, but I use fewer contracts, my risk can be about the same. But rule of thumb for the ES, for general purposes, a 4 point candle, what I would call the signal bar, the hammer or the inverted hammer, 4 points is a nice kind of happy medium. And you're kind of basing the moves and the candle size relative to some of the prior candles. So if we're in a really slow environment for the day, the candles might only be 1.5 to 2.5 points. And so if all of a sudden I saw a 5 point candle, that's going to be a really big candle relative to the candles in the day. But if volatility gets picked up and all of a sudden the average candle is 4 or 5 points and we get a 4 point hammer, okay, that's in line with the candle sizes for the day and ends up being a relatively kind of safe stop point. So getting long, 1 tick above the high, above the hammer, and then the stop, 1 tick below the low. That's the nice thing about futures. You can be down to the tick. You have the trade ladder to be able to manage positions. You wouldn't really want to trade options on this kind of a strategy because you're essentially buying a breakout. And if you're buying, say, just a straight up call option on a breakout, the call option is increasing in price as it gets to the breakout point. The best places for buying calls and puts and some basic option chain strategies are buying on pullback, so when the price is coming down. But you could use this strategy for just trading the underlying stock or even like the SPY, QQQs, so the equivalent ETF, Forex, and certainly daily bars, intraday. It really doesn't matter. It could be a 5-minute chart instead of a 1-minute chart. I mean, you could even go up to an hourly chart. Obviously, the bigger the time frame, you're going to end up with a much longer potential trade. So always placing the stop outside of the entry candle, which at first might seem like, okay, well, if the candle's 4 points and I got 1 tick for entry, 1 tick for stop, that's a 4.5 point risk. And there's a couple things that you can do to manage the trade when it comes to like when it's going your way. If the trade goes against you, getting stopped out, that's the easy part, or setting a stop is the easy part. But a lot of people don't really have a plan for what they're going to do if the trade starts going their way, and then you just kind of panic, or you take it off for a point, or you move your stop to break even when it's only gone a point, and then you get stopped out for break even, and it's just kind of a waste. So a couple things you can do to trail your stop, and again, this could be for this strategy or any other strategy. I use the same approach. So there's a couple basic things you can do. You could just resort to trailing each bar right off the bat. So I'm going to turn this chart off just for a second. So you could get long above a hammer and just keep moving the stop below every single candle as it closes. So you get in the trade, sometimes it could be 20, 30 seconds goes by and then the candle closes, and then boom, you can move your stop underneath that next candle. And then the next candle forms, makes a new high, and once you gotta wait for the candle to close, but we're talking a minute at most, and then you can move your stop underneath the next candle. And so you can just trail each candle right out of the gate, and that would be a little bit more of an aggressive trail stop approach, because you'd be assuming that the trade is going to every single candle, you're going to be trailing every candle on the run up if you're getting long, and if it goes against you by breaking the prior candle's low, then you get taken out. But what that does is it allows you to reduce the risk very, very quickly on the trade. So the second approach that you can do is trailing swing highs and lows. And so if we're long, an example of getting long above a hammer, starting with your initial stop below the low, and then just leaving it alone and waiting for the market to make a little bit of a bounce. It might take 3, 4, 5 minutes to get moving, letting it pull back. All the while, your stop is still at that initial point below the low. Even though you have an unrealized gain on the trade, your physical stop is still below the low of the candle. And then waiting for the swing high to break. So that's this white horizontal line here. Waiting for the swing high to break, and then moving your stop underneath the swing low. So in this case, you're being more conservative. You're letting the stop sit there at the initial stop point for 5-6 minutes. And then once it breaks a swing high, then you can move it up underneath the next swing low and continue that pattern. Let it break a new high, do nothing with your stop, let it pull back, and then when it breaks that next new high, you can move it up underneath the swing low. And so this pattern works. I mean, this is fantastic for swing trading when you're in a nice tight uptrend market and just trailing the swing lows on the way up. But you have to have the patience to sit tight initially with your stop and not get too aggressive out of the gate, because especially for the ES and for day trading, you can end up with you tighten your stop too quick. It's only moved a point or 2 points in your favor above your entry, and then you move to break even thinking, okay, I don't want this trade to turn into a loser. And then the ES, NQ, they're going to chop around a little bit. And so if you can just get through those first couple minutes where it's point above, point below, certainly not hitting your stop, but just kind of chopping around, then when you get to a larger move and it pulls back, it goes up 4 points and pulls back and starts to move higher. Now you're trailing your stop and you're kind of locking in bigger chunks of profit because you had the patience to wait at the start. And that's a really effective way to both focus on the quality of the trade versus trying to get in, get out, over and over again, buying above every high bar, selling below every low bar. It breaks a tick and then it reverses. You take the stop out and you go the other way. Trailing the swings is a super effective way to trail your stop. So trailing swing lows in an uptrend, trailing swing highs in a downtrend. And then the best part about kind of this approach is if you pair, so if you can get to a couple contracts with the E-minis, or even start on a practice account, then move to the micros, and then move to the minis. But if you can be trading at least 2 contracts, then what you can do is have one contract that is dedicated to this trail approach. Or let's say you're already trading 6 contracts, half of the position, so 3 contracts, can be dedicated to trailing the swings. So that half of the position is going to start with the initial stop below the low, and then give it some time to move, pull back, and then once it breaks out, then you're going to tighten the stop on that half of the position. But then the first half of the position, you can use a 3-point stop, which is what I use on, or a 3-point target, excuse me, which is what I use on the ES. The NASDAQ, you could use, maybe like 15 or 20 points. 10 to 20 points would sort of be the equivalent as far as like how quickly you get a move like that hit. Probably closer to 20 points. So it's not an exact dollar for dollar crossover, but the idea being, you can get a 3-point move in the ES and lock in that 3-point profit on the first half of the position. and then it could roll over on you, come back, stop you out, and if your stop is at 3 points and your profit target on the first half was at 3 points, you're at break even, but you allowed the trade to run, and if 4 out of 10 trades end up getting at least one swing low push or swing high and then pull back and then break a high, you can get a 4 or 5 point profit plus a 3 point profit on the first half, and all of a sudden, even with just 4 contracts, those trades can really start to add up. You can do kind of a combination of trailing each candle, and I try not to get too fancy with it, but if you're breaking your position up in half as the baseline and using a small target on the first half, so 3 points, and trailing the second half, you can leave your stop for the second half below the initial hammer, and you could start trailing each candle. So if you have 4 contracts, you could use a stop for 2 of those contracts, and you could trail each candle on the way to getting that 3 point profit hit. So there's some ways to kind of reduce your risk while also allowing for that larger home run. And that's kind of the big idea, is rather than stepping up to the plate and trying to murder the ball and swing as hard as you can, whether you're golfing or playing baseball, you use the same swing. And then sometimes you connect and sometimes you don't. And those times where you do connect nicely and you do knock it out of the park, you weren't doing anything different. You're just repeating the same process over and over and over again. And so while it might seem enticing to want to take like a point or two and try and increase your frequency of trades and kind of being in a scalp mentality where maybe you're taking a 2 point profit and a 4 point stop, that can work to a degree where you're okay, boom, locked in 2 points, another trade of 2 points, another trade of 2 points. But then you have a day where you have just a couple of stop outs, and all of a sudden it's like boom, 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 4 points, 4 points, 4 points, and you just gave back the whole week of profits. So psychologically, it can become, and you really don't realize this stuff until you're actually trading or you're taken out of a trade too early, and then you see the thing totally take off. And a lot of you have probably been there. You get in a trade and it starts to go your way, and then it starts to stall, and you're like, ooh, I'm up 2 points. I'm just gonna take it off, or I'm just gonna hit the flatten button, or just get out. Okay, whew. All right, cool. I got my $100, or I got my 2 points, and then it just keeps ripping, and you're like, well, shoot, I should have if I just stayed in the trade, I could have locked in 10 points. And so then the next time, what do? You say, okay, I'm gonna sit on my hands. I'm gonna stay in this trade, and it goes 3.5 points and reverses, and you're like, well, shoot, I should have just taken the profit and gotten out. And so this way, by splitting the position in half and dedicating the first half of the position to a kind of small profit target, still decent reward to risk. Yes, if it's a 4 point stop and a 3 point first target, you're inside of 1-to-1, but for a lot of trades that are 2.5 point candle, you're still slightly over 1-to-1, and the chance of getting 3 points hit on the ES is pretty high for like a small move like that. And then just trailing the second half of the position. That's a really, really good way to manage your trades. You could do the same type of approach for swing trading. Let's say your entry candle is $5 on Apple. You take a profit at, you set a profit target on the first half, or on like 25% of the position, to take a profit off at plus $5, or plus 750, a 1-to-1 or a 1.5-to-1, just to kind of reduce some of the risk on the trade with 20 to 30% of the position. And then not only does that lock in a little profit and take off some of the risk, but what the most important thing that does is it allows you room to breathe and allows you to stay in the trade long enough to get that winner. Because even if you have a 10-point unrealized gain, you're looking at your trade ladder, you're got a 10-point gain, but your stop is 10 points away from where price is, there's always that tendency to want to, move the stop up, or as you start getting into more and more contracts, if you're trading 10 lots, it's pretty easy to say, oh, I just take 2 off here. I'll just take another 2 off. And all of a sudden, the trade's only gone 3 or 4 points, and you started with 10 contracts, and now you're down to 3 contracts left, and it barely got going. So having an approach to manage the trade when it goes your way is super important, because that's when a lot of the subjectivity comes in and starts kind of playing with the emotional side of things. So we talked about trailing each bar. One thing I will do, if my stop is below the signal bar, so below the hammer, and we start to take off, if we get 4, in the case of a hammer, 4 green candles in a row, I will immediately move my stop underneath that 4th candle low. There's no reason if I get in a trade and it just rips out of the gate, and I get 4 candles that go higher high, higher high, higher high, higher high, then there's no reason to let an 8-point profit come all the way back and stop me out for -3. So I'll move my stop up underneath the 4th green bar, 1 tick below, and then just continue trailing each candle from there. And some days the market is super clean, and it just goes, every candle is a new high and a higher low. And those days are great, and it's super clean. Other days, it's just beautiful stair stepping, higher high, higher low, higher high, higher low. And so this kind of allows for, if the market does rip, I don't have to sit there with a 12-point unrealized gain waiting for it to pull back. I can kind of jump ahead and lock in some profit. From a kind of the basic long principle, it could be a hammer at lows. It could be a hammer in an uptrend. Hammer at a double bottom is a really nice setup, because you're essentially rejecting price the second time on the double bottom. And then, as I said at the open, looking at the nicey tick to be in a relatively low tick if you're going to be going long, and a relatively high tick if you're going to be going short. And then just turn that over for a double top. For a short, you could be coming up to the high of the day. You could be coming up to the high of yesterday. The prior day's high-low close is a super good place to look for trade setups. So inverted hammer at highs, hammer down at lows. 30-minute range is a really good, those are what the 2 lines here are, the 30-minute range. Those are really good places to look for trades. And yeah, when you're in a range-bound situation, selling highs and buying lows is a really good spot to look for trades. So to kind of summarize everything here, the entry would be above a long, or to go long would be above the hammer, and that could be double bottom at a halfway back, could be 21 exponential moving average, could be the prior day's high-low close, especially the prior day's close when we fill the gap. That can be a good reversal point. Could be a long in an uptrend. Those 4 areas are really good. And then joining that up with a low nicey tick. And then inverted hammer for going short could be at a halfway back, a 50% retracement, prior day's high, double top at the 21 EMA in a downtrend, and then pairing that with a high nicey tick. And then starting with your stop at the outside of the entry candle. So if you're going short, 1 tick below is your entry, and then 1 tick above the candle is your stop. If you're going long, 1 tick above the candle is your entry, 1 tick below is your stop. And then when it comes to trailing the stop, either trailing swings, trailing each candle, and if it does start to rip very quickly, then just after 4 bars in a row, just moving the stop underneath that 4th bar to bring up your stop, lock in the profit, and then just keep trailing each bar every 1 minute as the candle closes. So if you're interested in more trading knowledge, if you will, I've got all kinds of stuff over at EminiMind, the Discord room. Weekly, I do trade recaps over there, free articles and resources and stuff like that. The weekly trade recaps I put on YouTube as well. Do some live trading sessions and a little bit of one-on-one mentoring. I spend probably most of my time, for as much time as you spend actively trading for those couple hours a day, I do spend a fair bit of time reviewing my trade log and going through my trades and my journal and things like that. And that's really where a lot of the insights and kind of aha moments have come. So if you are stuck in a rut, or if you're kind of banging your head against the wall, go to your trade log and your journal, and kind of looking at things outside of market hours can be really helpful. Reading trading books are great, but reading other books that aren't trading related just kind of allows your mind to subconsciously process, and work on problems that you're working on consciously. But then if you're taking yourself out of the equation and looking at reading a book or doing other things, going for a little walk or a hike, your brain is still processing that stuff in the background. So thanks everyone for tuning in today. If you have specific questions, you can always shoot me an email. It's just tim@eminimind.com. Otherwise, you can check out the other free articles and things over at EminiMind, and hope you have a great rest of your day, and good luck with all your trading.